Investing in private markets has had a bit of a bad rap in the past. You have to have big bucks to get started. There's no transparency in how your capital is being put to action, and you have to lock that capital away for years. So, in this episode of How to Invest, we'll be busting private market myths. But first, what are private markets and how can you get involved? Well, private equity is probably the area you are most familiar with. It makes up around 60% of the private market landscape and is essentially investing in a company that isn't on the stock exchange. You can get involved at different company stages, from venture capital, which is investing in startups, to growth equity to help them develop further, to leverage buyouts, where companies need to be transformed and sold on. Private real assets investing makes up around a quarter of investment opportunities. Here you can invest in real estate, buildings, pipelines, or even farmland. And buying real estate means you'll either add value with some serious refurbishment, or you'll be looking to create opportunistic value, like changing the use of that real estate, buying an old church and converting it into apartments, for example. A third, smaller but growing sector within private markets is private debt, essentially private lending. Once only available in the US, this is gaining traction since its introduction in Europe. Basically, investors can step in where more traditional lenders do not or can only go so far. The investment can be convertible and then turns into shares of the company once it's more fully developed. Now you know the landscape, let's bust those myths. You don't have to be a Warren Buffett level investor with loads of cash to access private equity. Nowadays, it's much more common to pool your resources into a fund. Like-minded investors all contribute, and the investment is spread over several companies to add some diversification. Private markets are not a black box. You can have transparency on how your investments are being used. Certainly, companies in the private markets are not subject to the same reporting requirements of a publicly traded one. But here, trusted sources and experienced managers are pivotal in doing due diligence and then monitoring investments, often by sitting on the board. Your assets aren't locked away for many years with private markets. The rise of the secondary market has enabled investors who need access to their cash to have the ability to sell their stakes to other interested parties. So where's the rub? Well, private equity fees can be expensive. But remember, this is not a passive investment, rather a highly active one that requires expertise. Why take a cab with a young, inexperienced driver with a basic sat-nav when you can take one with an experienced driver who knows the city well and can take you to your destination potentially even quicker? When considering private markets, it's important to consider risk, return, and liquidity needs over time. You can find out more about risk and return in our episode on designing your own portfolio. Don't miss an episode of How to Invest by liking and subscribing to the Julius Baer YouTube channel. And if you have investing questions you'd like us to answer, just comment below, and we'll see you next time.